When one of the world's most famous investors, the man who predicted the 2008 housing crash, doubles down on a struggling beauty giant that's lost half its value, people start to take notice. On May 16, 2025, Michael Burry's Scion Asset Management revealed it had doubled its position in Estee Lauder to 200,000 shares, worth over $13.2 million. This is the same Estee Lauder whose stock has plummeted nearly 60% over the past 3 years. The same company that's currently engaged in the most dramatic transformation in its 79-year history. This isn't just about makeup and moisturizers. This is a story about a $26 billion empire fighting for its story in the trillion-dollar beauty industry. It's a story about China, travel retail, social media disruption, and whether an American icon can reinvent itself for a new generation. We're diving deep into what's really happening at Estee Lauder in 2025, analyzing their ambitious beauty reimagined transformation, and asking the question, is Michael Burry seeing something the rest of the market is missing? Let's rewind to 1946. Estee and Joseph Lauder launched their skincare company in New York City with just 4 products. Estee's revolutionary approach? Going directly to customers, applying her creams to women's faces at beauty salons and hotels. I never dreamed about success, I worked for it, Estee once famously said. By the 1990s, the Lauder family had built a powerhouse, but what came next truly transformed the business. Under then CEO Leonard Lauder, Estee's son, the company embarked on an aggressive acquisition strategy that would define its future. It started with La Mer in 1995, which is now one of the most expensive skincare brands, with creams costing upwards to $2,400. And then came MAC Cosmetics in 1998, bringing artist-grade makeup to the masses. Then in 1999, Jo Malone, elevating home and personal fragrance to luxury status. That Jo Malone acquisition, the brand was generating just about $50 million in annual revenue when Lauder bought it. Today it's one of the top 5 brands globally. This is what Estee Lauder does best. They identify niche luxury brands with potential and scale them globally. By the mid-2010s, Estee Lauder was riding high. They own more than 25 prestige brands across skincare, makeup, fragrance, and hair care, selling in over 150 countries. But they were about to make a strategic bet that will later come back to haunt them. China, the promised land for luxury beauty. Between 2010 and 2019, Estee Lauder poured billions into capturing this market. A $1 billion manufacturing facility in Japan, an innovation center in Shanghai, a massive distribution hub in Switzerland supporting duty-free sales to Chinese tourists. The strategy made perfect sense. China's middle class was exploding, with consumers hungry for Western luxury products. By 2019, China and travel retail, heavily dependent on Chinese tourists, had become Estee Lauder's growth engine, delivering double-digit increases quarter after quarter. Wall Street loved it. The stock soared over 300% between 2015 and 2021. Competitors like Coty were scrambling to catch up to Lauder's China presence. The COVID-19 pandemic hit. China implemented some of the world's strictest lockdowns under its zero COVID policy. International travel collapsed, and when China finally reopened in late 2022, the expected consumer spending boom never materialized. By Q3 of fiscal 2025, Estee Lauder reported a devastating 10% decline in net sales to $3.6 billion. Organic net sales fell 9%. Operating income plummeted 42%. Their once celebrated China and travel retail strategy had become an anchor around their neck. But China was just one part of Estee Lauder's perfect storm. Let's break down the other factors. First, innovation stalled. While competitors launched hit after hit, Estee Lauder's new product pipeline seemed to slow. In makeup, brands like Rare Beauty and Makeup by Mario captured Gen Z's attention, while Lauder's legacy brands like MAC struggled to stay relevant. Second, the rise of social media and direct-to-consumer brands completely disrupted beauty marketing. Lauder was late to platforms like TikTok Shop, which is now generating an estimated $1 billion in annual beauty sales in the US alone. Third, retail transformation. While Estee Lauder focused on department stores and duty-free shops, consumers shifted to online shopping, like specialty retailers like Sephora and mass channels like Amazon. Lauder was slow to adapt, only launching brands like Estee Lauder itself on Amazon in October 2024. The results were devastating. Estee Lauder stock tumbled nearly 50% in 2024, 42% in 2023, and 33% in 2022, wiping out more than $100 billion in value in just 3 years. Hey, before we finish this video, I just want to say thank you for watching. If you guys could hit the subscribe button, it means a ton. I'm hoping to get on my real estate job one day to make this my full-time gig. But for now, thank you for watching. Enter Stéphane de la Favre, sorry if I butchered that name, who took over as CEO on January 1st, 2025. Just 1 month into the job, de la Favre unveiled what he called Beauty Reimagined, Estee Lauder's bold new vision to restore growth and become profitable. De la Favre didn't mince words. He said, "We lost our agility. We did not capitalize on the higher growth opportunities quickly enough in channels, markets, media, and prestige price tiers, nor fuel new customer acquisition aggressively enough." The Beauty Reimagined strategy breaks down into 5 key areas. First one, accelerating best-in-class consumer coverage by expanding into high-growth channels and markets. Creating transformative innovation with faster-to-market, trend-driven products. Boosting consumer-facing investments, particularly in advertising. Fueling sustainable growth through operational efficiencies. And streamlining work processes. But this transformation comes at a steep price. In February 2025, Estee Lauder expanded its restructuring plan to include laying off up to 7,000 employees, nearly 15% of the global workforce. The company estimated costs between $1.2 billion and $1.6 billion through fiscal year 2026. They also slashed the dividend nearly in half, a virtually unprecedented move for a stable consumer products company to conserve cash for the transformation. Which brings us back to Michael Burry, the investor made famous by the movie The Big Short, which bet against the housing market before 2008. Well, he just doubled his stake in Estee Lauder to 200,000 shares worth $13.2 million. What makes this particularly interesting is that Burry has actually reduced his overall portfolio from 13 stocks down to just 7. And Estee Lauder now represents one of his largest positions. He's not just maintaining his stake, he's doubling down while reducing exposure elsewhere. So what might Burry be seeing? First, valuation. After falling near 60% from its peak, Estee Lauder trades as much lower multiples than historical averages. Second, the turnaround plan. Beauty Reimagined represents the most comprehensive transformation in the company's history. The massive cost cutting should help restore profitability even if sales remain challenged. Third, the China tariff truce. The recently announced 90-day trade war truce between Washington and Beijing brings US tariffs on China down to 30% from a potential 145%. This could significantly ease pressure on Estee Lauder China's business, which accounted for about 31% of total sales in 2024. And fourth, the beauty industry itself remains resilient. Even as consumer spending has softened in other areas, global beauty sales are projected to grow 7.3% in 2025, with the sector on track to become a $1 trillion industry. But Estee Lauder's recovery isn't happening in a vacuum. Its largest competitor, L'Oreal, reported 4.4% sales growth in Q1 of 2025, nearly tripling analysts' expectations of 1.3%. While Lauder was struggling with its China exposure, L'Oreal's La Roche-Posay became the fastest growing skincare brand in 2022 and 2023, while Lauder's brands lost market share. And L'Oreal moved faster in e-commerce and social settings, particularly in China platforms like Douyin, which is pretty much China's TikTok. And then there's LVMH, which generated $8.7 billion in beauty sales in 2024 and is steadily gaining ground. Its perfumes and cosmetics business group achieved 4% organic revenue growth in 2024, driven by standout performances from Christian Dior, Guerlain, and Fenty Beauty. And the disruptors keep coming. Rare Beauty, Makeup by Mario, and dozens of digital native brands that connect with consumers in authentic, innovative ways that legacy players like Estee Lauder have struggled to match. So what's next for Estee Lauder? The Q3 results showed that the turmoil will be neither quick nor easy, but there are glimmers of hope. The company reported prestige beauty share gains in strategic markets like the US, China, and Japan, and mid-single-digit organic net sales growth online. Global business organic sales trends, excluding travel retail, showed sequential improvement, and the margins are starting to recover. Gross margin expanded 310 basis points to 75% in Q3, despite the decline in net sales. De la Favre expressed confidence that the company will return in sales growth in fiscal 2026, provided there is a meaningful resolution of the recently enacted tariffs. Technology will be crucial to the turnaround. Estee Lauder is building a generative AI ecosystem with Microsoft to gather data, identify trends, build marketing assets, and inform product development, potentially helping them catch up on the innovation front. The company is also looking beyond its traditional strongholds to regions with explosive projected beauty growth, like Latin America, and Africa. So will Michael Burry's debt pay off? Can Estee Lauder's $1.5 billion makeover restore the beauty icon to its former glory? The challenges are immense. The company must address fundamental shifts in consumer behavior, rebuild its innovation pipeline, and reduce its dependence on China and travel retail, all while cutting costs and maintaining brand equity. The bull case is built on Estee Lauder's portfolio of iconic brands, its new leadership with a clear vision, and its willingness to make painful but necessary changes. Plus, the beauty industry itself remains resilient even in economic downturns. The bear case centers on execution risk. Transformations this large are pretty difficult. Competitors aren't standing still, and the company may have structural issues that go beyond what cost-cutting alone can solve. What's clear is that this isn't just about recovering from a cyclical downturn. Estee Lauder is fighting for its relevance in a rapidly changing beauty landscape where legacy alone no longer guarantees success. In the beauty industry, transformation is everything. Products promise to transform your skin, your appearance, your confidence. Now Estee Lauder must transform from a company built for the department store era to one that can thrive in the digital age. While it's too early to declare victory or defeat, one thing is certain. The next 12 to 18 months will determine whether this American beauty icon can revitalize itself for a new generation or fade into history as another cautionary tale of destruction. For investors like Michael Burry, it's a calculated gamble on whether Beauty Reimagined can truly reimagine Estee Lauder's future.